Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of April 27th, 2025. And in this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at what the heck do you do with all those profits once you finally figure out how to make them. And to help us kind of frame that conversation, we're going to go back to one of the childhood stories that I used to hear as a kid. And it was an Aesop's fable on the ant and the grasshopper. And we're going to kind of talk about maybe which personality do you more closely identify with. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, as well as /ViperXL007, where we post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's episode. Viper profits. You know, someday, if you work hard enough and you stick with it long enough, you'll eventually have some, or so it goes. And I think you end up posed with an interesting question: is what do you do with these profits? Because once you finally kind of hit it, it feels pretty good. And I'll kind of talk through a little bit about my approach to things, but I kind of want to bring up an old story from Aesop's fables of the ant and the grasshopper. And I won't go through the whole story, but generally it goes, in the summertime, the grain and the fields were there, and the ants were kind of going through the field, and they were harvesting all the grain that the sun was drying, and they were kind of squirreling it away in their burrows for the winter, because they knew that winter was going to come, and there's not a lot of food in the winter, and they were going to kind of harvest all this grain stored in their storehouse so they can kind of survive the winter. And the grasshopper was just super happy that the sun was shining, the grain was plentiful, he would snack on this, he would fly around, he danced, he made music and all this stuff, but he never really prepared anything for the winter. The story goes that the grasshopper, the cold winter wind came in and all the grain disappeared and the food went away, and he started getting really frail and hungry, and he went down to the ant and he says, "Oh, please, Mr. Ant, I need some food. I need some grain. I know you have some." And the ant said, "Why did you spend all of your day frolicking around in the fields and the summer sun?" And he's like, "Oh, it was beautiful. It was music. I had to dance." And the ant says, "Well, then go dance now. You should have prepared for this," and basically went back into his burrow. And the grasshopper kind of, danced around and died, I guess. But that was kind of a story of, really what do you do with surplus? What do you do? And the fable really is kind of about, there's a lot of merit to hard work and planning and for the future. And I kind of feel like that's an aspect of something that you have to kind of think about when you get these profits, because I think there's different approaches that you can have. I mean, some of this stuff it's hard work that you put in to learn to get them, but it's also like a passive income. So, once you kind of dial this in, you can kind of scale it up without a lot of extra consumption of time, and it might afford you extra little luxuries in life. And what do you balance between, really preparing for that winter like the ant, but maybe still having a little bit of fun like the grasshopper, but not so much that, you spend all your time having fun and you have no preparations there for the winter. I don't know, Viper, if that's something that you've kind of come across as you maybe have gotten a few profits or things like that. I kind of see how that hits you or what draws thoughts in your minds first.
Well, first of all, that is not how I remember the movie A Bug's Life going.
Well, those grasshoppers, man, I don't know. Maybe they were more armed.
Those grasshoppers just flew in and took the grain from the ants. But yeah, so the thought experiment, not really a thought experiment, but actual plan that I'm trying to lay forward here is born of Exactly what you said. Having these profits. So just a small backstory. I have what I have affectionately come to call my YOLO IRA account. And, and the reason I call it that is because once upon a time in my first job in my career, first job out of college, I had a retirement account. Didn't really know anything about it, anything about what I was doing or anything like that. So I put a small amount, not near as much as I should have, but I put a small amount into the retirement account. Um, and then within 2 years, I got a new job and had a much better understanding of what I wanted to do with my 401k, with my retirement contribution. So getting the new job, really took the contributions more seriously. And then that continued. And so then I realized, well, I have this other account from the old job. And I mean, it was by comparison, a pretty small account. um, and so first thing I did is I rolled it over. I rolled it out of the custodian that was taking care of it at the old job. Kind of rolled it into a Fidelity IRA, retirement IRA, and then within I think it was less than a year, my new 401k had surpassed the value of this rollover, and so I was like, you know what, this is I'm not even going to rely on this money in this old account as retirement money. So let's just mess around. And at that time, Beyond Meat was the thing, and they were having their IPO come up. And so I was like, you know what? I still don't know much about stocks and investing, but at the time I was really big into what was happening with Beyond Meat, and had this investor thesis of like, this is going to be awesome and everybody's going to love it. And not saying I was correct in how I assessed it, but I wanted to partake in it. So I just put the whole account into it on IPO. Next thing I know, that went really well for anybody who remembers or was there for the Beyond Meat IPO. And I was at least smart enough. I don't know how smart it was. It was a lot of luck was going on at this time with running this account. But I made really big profits on that, and then I kind of rolled that into got into the semiconductor industry with it before it was cool to have things like Nvidia in your profile in your portfolio, and just kind of stumbled into that. And again, I'm treating this account as this, this is throwaway money sandbox. I'm just gonna throw it all at this stuff. And now I'm to the point where after the Beyond Meat thing, after the semiconductor exposure, after the Bitcoin ETF exposure, I'm kind of looking at this account now. And then after most recently, because I've talked about this account a little bit before with Robinhood and Coinbase, and getting into those before they've recently exploded. So I'm now looking at this account like, okay, at some point I gotta stop this. I gotta stop the casino games and hitting the slot machine because that's just never going to end well. And I'm extremely lucky to have gotten as far as I have with it. So I'm at that point of I'll still reserve a small portion of it for these, just kind of knee jerk, oh, let's try that or whatever. But throwing the whole account at it is no longer a great idea. So I am looking for I don't know if sustainable. I mean, I guess I'll use the word sustainable, but I'm looking for a strategy that is going to more wisely, responsibly take care of what has been built out of almost nothing so that I don't keep rolling the dice until it's all gone, because I'm on much smaller amounts. I am very well aware of that side of things. So that's kind of where it came from and where I sit today.
Well, I gotta hand it to you, Viper, because I swear you must have the best luck when it comes to equity trading, because that's a couple of nice sets in there that you stumbled on accidentally. And I recall a few different prior times where I said, "Oh my gosh, Viper is selling. Get the heck out of the market." And what do? We dump like 2 weeks later. I think that happened twice. So you seem to be a lightning rod for good luck or good fortune. So maybe I got to pay closer attention.
The next Warren Buffett right here, guys.
Yeah, the oracle of the blockhead traders. So yeah, Viper. I guess I've not been as fortunate as you in some of my trades and stuff that I've done in my retirement account, but similar to where I think you kind of use that as almost like a little bit of a experimental ground. When I was kind of refining my option strategy very, very, very early on, I had a super tiny amount. Basically, I started my whole options trading journey with $2,500. Like, I went in my bank account and I said, you know what, $2,500 seems like an appropriate amount. I can afford that. So that's what I started with, and my strategy was working. And these tiny little trades that I was making, but I really, really wondered, does it scale? Does it work in a larger account? And so there was a very brief time, probably about a 6-month period early on, where I didn't have the capital to try that out, except in the IRA account that I had. And so I put together the plan that I wanted, the strategy that I wanted to, and I used that in that IRA account for approximately 6 months. And what I use that for is validation on volume, or validation on a larger account size. Now, it wasn't huge by any stretch of the imagination, but it was considerably larger than the $2,500 that my little onesie twosie play was panning out. But I wanted to see, does this work at 5 plays at a time, 6 plays at a time, 10 plays at a time. And so I did kind of use the IRA as that proving ground, which is similar in theory to what you were kind of talking about.
Very, very similar in the fact that that's exactly, like I said, the account where I want to deploy this potential strategy. So I wanted to lay out this strategy for you and see what you thought of it. And part of me has a feeling that you're going to hear the strategy and be like, dude, are you, this is like, it feels like it's like a strategy you've talked about a lot, and like falling on deaf ears type thing, where all of a sudden I'm like, hey, I got this great idea.
This is going to be like a live episode, but it's not a live episode because I really have no idea what you're about to tell me.
So, what I'm thinking is short straddle, and in this particular case, so deploying a short straddle on the S&P 500. And so big picture, the play idea is this account that I have, and easily if I kind of restructure some of the investments that are in there now, cash up get a good cash pile in there, sell off a bunch of stuff, just to organize the account. So there's enough cash that once I do all of that, there's enough cash that I can be cash secured for, let's say, 2 contracts of SPY if needed. So running a short straddle. So for those who don't know, the short straddle is when you sell a call and a put at the same time, anywhere you want away from strike. And so what I'm thinking is running a strategy where I am selling, where I'm selling, calling a put, and I'm in that 15 to 20 delta range. I've considered as low as 10 delta. So the purpose there is that this is very far away from strike currently, and selling it on that 30 to 45 days to expiration timeline, which is in the range where I think you like to sell. And so the idea behind it is several outcomes from this. Outcome number 1, we sell, we expire, nothing happens, we roll it again. We sell, we expire, nothing happens, we roll it again. And the fact that I am comfortable with up to 2 contracts, so 200 shares of SPY, I'm thinking about staggering, maybe, where I do a straddle, then 15 to 20 days later, I do another one. And so then I have this staggering dual plays for maximum efficiency. So in the world of possible outcomes, though, so expire worthless, do it again. Expire worthless, do it again. Outcome number 2 possibility, we breach the put. Let's start with the put side. We breach the put. cool. I just bought 100 shares of SPY on discount from where the strike was. So now the strategy shifts a little bit. Now I'm in hand 100 shares, and we just do the covered call thing. You know, we sell some covered calls while we're waiting for price to recover, bottom, whatever. So that's outcome number 2. Outcome number 3 is where we breach the call side. And let's say I don't have any shares. So this is a naked call. So my strategy, my thought on the call side is, if price is looking like it's going to breach my call strike, then I simply buy 100 shares before we get to the strike, because I really don't want that. I don't want that risk of a naked call hanging out there. So if it's looking like, you know, price is getting closer to that call strike, then before we get there, I buy. Or I guess I could do it even after, but say before we get there, I buy 100 shares, and now all of a sudden that turns that call into a covered call, and so I don't have that exponential loss risk to the upside. And there's nuances to that. So if I'm doing the staggered position thing, and I get assigned on one of the puts, and then maybe then the next half a month we're pushing the call, it just turns that second position into a covered call essentially. So nuances are like that as far as management, but that's the high level thinking. And the final thought of why SPY is because this is, I mean, let's just real quick jump over to the chart here. Due and large, this is an up only chart. So that's, and we're talking on it. I mean, this is in a retirement account, so I'm not actively accessing this money. So in the case of assignment, even though I said I was going to roll the covered call, I'm going to be pretty loose with that, because, over enough time, the price is, by statistical means, what do they say? If you hold the index for 10 years, you're in profit or something like that since the beginning of time. So the idea here is taking assignment, totally okay with, and we're running on a timeline that's long enough that even if I don't do the covered call, I take assignment and then I just wait. And then I wait, and then, price comes back and whatever, and then we just keep rolling with it. So that's the general idea. And the last thing I'll say is it also started with the idea, the SPY is slightly larger, obviously. So taking assignment, actually, compared to what I was going to say, I don't think it's that much bigger. One thing that came across when I was looking at what to run this on was this UPRO, which is an S&P 500 ETF. However, this is a leveraged ETF. So it's on my radar, but I haven't done any specific price comparisons between UPRO and options pricing and SPY to figure out if I want to run this on UPRO versus SPY. Obviously, the on the cons list of UPRO, even though it in theory tracks SPY, it is leveraged at 3 times leverage. So what that means is on SPY, when it pulls back, it pulls back a little bit, 20, 30% max maybe. But as a leveraged ETF here, you can see if UPRO pulls back, it's pulling back here from 40 all the way down to 10. So that's a pretty significant pullback, but does match that up over time situation. So don't know if you have any thoughts on that specific part, but that's the general idea. Leveraging an index's nature to be quote unquote up only, but also doing it with a strategy that can withstand the test of time due to the need of that money not being anytime super near future.
Sure. So there's a lot to unpack here. But let's start with the you kept using the word straddle, and then you defined straddle correctly as a put and the call at the same strike. But then you talked about a delta. So can you
Not It's not same strike. Straddle is selling a put and a call at different strikes, right? So,
That's a strangle.
so right now, that's a okay. So short strangle. It's like, well, but no. So like right now, SPY is at 535. So if I go sell a call at a 600
Mm-hmm.
and sell a put at 500.
Yep, that's a short strangle.
Okay. So incorrectly used straddle when should be strangle, but I believe everything else holds up as far as how to run the strategy over time.
Okay, so yeah, so Viper, it's a common thing that gets confused between there is straddle versus strangle, and straddle is basically at the exact same strike because you're straddling the strike, which is where that term kind of comes from. It's how I try to keep it straight in my brain. Is that when you're talking about a straddle, you're basically like a balancing beam. You're standing on a point, and you could go left or you could go right. And so when you sell or buy the exact same strike, but one's a put and one's a call, that is a straddle. When you go different strikes, when you're basically making more of a trapeze, or think of it like you're going around somebody, your throat to choke, right? You're going to strangle it. So you got your one hand at one strike and your one hand at another strike, and you're going to strangle a range of price. That's where you're selling something out of the money on the put side and out of the money on the call side. And that's generally what I sell in general, is strangles, because you get to capture the premium on the top side and premium on the bottom side. And usually you're doing this, in my plan, is you do it when volatility is extra elevated. So you have a higher probability of volatility contraction, which means if volatility is overstated, you're likely that you're going to stay between those strikes. So that stuff aside, the other clarification I actually want to make is I don't believe you can sell a short call in a retirement account. You can still do your plan, but what you'll have to do in a retirement account is you'll have to add a leg to that short call as a long call. You'll basically have to put a protection leg on it, because it is against trading regulation to go into a retirement account with an undefined risk trade. You can't do it. They will let you sell just a put, but what they will do is they will hold in escrow 100% of the value of that put. So it's called a cash secured put. So if that underlying contract is worth 50 grand, they will pull 50 grand of your buying power away. Whereas in a regular account, that might be $5,000 in buying power that gets pulled away from your account.
Would everything work as I laid it out if I start, because like I said, account size I'm comfortable with 200 shares, 2 contracts. So would everything, as I said, laid out work if I start by just buying 100 shares of SPY, then
Yes.
doing the strangle, and then essentially it's a covered call to the top side, and then it's a cash secured put to the bottom side?
Yes, that's actually one of the other protections that I didn't mention. But yes, if you own the shares, they will let you sell a call against them because it's defined risk. It's protected. So you could do that. And in fact, I often tell people that some of the best ways to enter option selling is to do it on the short put side. Because it's really like a limit order that says, okay, well, I'll buy 100 shares of whatever at this price. And that's where you can start to experience it's like getting paid for the limit order. So your plan is actually pretty sound. It's pretty close to what I do in my trading style. There's I'll give a couple of drawbacks first, but then I'll give a couple of pros. So to me, the biggest drawback that you're going to experience is I don't think you're going to get as much of the capital gains in this account as you would if you would just kind of buy the SPY and hold it for 10 years. You might, particularly if you do the covered call, but you're going to miss out on a couple of swings. However, it is a way to profit from a lot of sideways movement. And that's anytime your index or anything really goes sideways, that's where I think a lot of the premium selling brings a lot of value, because if you just held the shares, you pretty much get nothing on general sideways movement. You might get a dividend if the stock pays dividend, but if you're selling premium, it's like a fabricated dividend. In fact, a lot of times people sell calls against their shares strictly to make it like a dividend paying thing. And so I think approaching it as selling that cash secured put on a downward move is good, because your volatility is going to be up. And so you're going to get a better premium for that. The other thing is, I can't say that I have looked at the options chains for SPY. I think SPY is pretty decent option chain. I don't know about the leveraged ETF that you talk about. You'd have to look at that option chain. A lot of times ETFs and things don't have very wide premiums, which basically what I mean is you can go like 5% out and the premium's all gone. Like it drops off really, really sharp with ETFs. And I don't think that's really true on the SPY. I think that's a pretty decent one to sell premium on. But I know a lot of other ETFs do have that drawback where there's just not a lot of price volatility, let's say, in the option pricing. And so you can't really get far away from the current strike to sell your premium. And the very last part that I would call out is, I don't know if it's a plus or a minus, but putting something on the call side of a generally up and to the right, it's because it's going to have to be defined. It's going to really that's where you're going to eat into the most of your profits, I think, because if the index is running and you get capped out on your short call, because your covered call, that's where you're going to see an opportunity loss. It won't be a loss in premium, right? Because you'll collect the premium, you'll collect the profit. You're going to do that call at an already a higher point than you bought the shares if you were assigned, right? But you'll miss out on the other movement that happens with that. Now, if you add a little bit of flavor to that and you start putting price action with that, and you start selling your call at a defined price level as you approach it, that's where I think you can increase your probability that you might get a turnaround and not actually get those shares called away, because it might not appreciate past that strike. You might get a retracement or something like that. That's where I think I would probably suggest a small tweak on the call side, is you don't just blindly put a covered call out there. You put that covered call strategically around some sort of price action level. And you might need to wait for that price to arrive there. Because you're going to get more premium the closer you are to that strike. So a lot of times when I sell a covered call, I'm going to sell the covered call at a higher delta. So for example, when I get assigned shares, I might be selling that covered call at a 40 delta or a 35 delta, whereas I might be looking at more of a 25 delta on the put side when I go to sell a 30 or 25 delta when I go to sell a short put.
So I'm kind of getting the sense that, so as I understand, when somebody uses phrases like a strangle or a straddle or, whatever, that the idea of those options setups, iron condor, well, whatever it is, that the idea is to put the legs on all at the same time. Obviously, some of those you have to, like an iron condor, you have to put those on at the same time. That's the point. But in a straddle where it's essentially naked call, naked put, it sounds like what is probably better is, instead of trying to think of putting the straddle on, or the strangle on at the same time, I'm kind of getting the sense that there's more opportunity to capture if I just decompose it into pieces and parts. So step number one is, and again, some of this thinking is coming from the fact that to anybody that's been in the market the last month or two, SPY is down. And so it may not be at the bottom, but it's down enough that it's a good place to start getting exposure to. So it sounds like I maybe need to piecemeal the plan a little bit where, again, still somewhat hypothetically, like I would still a little more strategically place these things, but because we're down on the SPY, we're down, we can see here on the chart, we're down, some 20%, 16, 17% from all-time high. So like I mentioned, not immediately, but strategically picking up 100 shares of SPY. And that's just a good exposure long term because we are down so significantly. And then from there, like you were saying, more strategically placing those either covered calls or cash secured puts. So in this case, because we are going down, maybe the next dramatic drop down, go ahead and sell that cash secured put. And now we hold off. There is nothing on the call side. There's 100 shares in hand. There's the potential to pick up another 100 shares. And then we just kind of pause for a minute, see what happens, see if we get a sign, see if we, if we start bouncing back up, and then waiting for that important price range on the top side to then go into covered call mode and capture some of that. So essentially, I guess not really calling it a strangle anymore, but now just paid limit orders at that point, because both the cash secured put as well as the covered call are exactly what you mentioned, paid limit orders, where I'm just now leveraging that function up.
Yeah, you can look at it that way. And what you're basically describing is what's known as legging into a strategy. So you apply one leg and then you wait for something to happen and then you apply the second leg. And that is legitimate. And I would tell you what I do because I've done it both ways. Right now in the uber volatile market, it really depends on where we are in a particular swing. And so one of the indicators that I kind of use for this, aside from price action, I think price action is a really good thing to use where you call out your levels. If you think you're be in the middle between two major levels of somewhat, and you're kind of in no man's land, that's a time where you might put the full strangle on right out of the gate, right? You do the put and you do the call at the same time because you believe the underlying is in the middle of the trading range. Now, if you got a big down move, so take it like when the tariff announcement came out. This is something myself and some of the other traders in Blockhead in the Discord did, is we dumped, 5%, we dumped 6%. And that rapid drop just rocketed volatility up. And we said, okay, let's sell this volatility. But we knew that there was a very high probability of an elastic move in the other direction, in the upward direction. So we legged in to that strategy, right? We only sold the put side because we felt pretty confident that we were approaching a level of support. And with that much volatility, we could really reach down to other levels below the next level because that volatility afforded us that extra movement in premium where we could sell a whole lot further out of the money and still collect very good premium. And then once we started to get the rebound, and you start rocketing up, 1% and 2% in a day, you're like, okay, we're getting ready close to ping pong off the ceiling now. So you know what? Let's go ahead and sell a call against that. And so I know I did that a few times on ES. I did it again on the Russell, where I was basically legging in. And then more recently, where I felt that our back and forth was starting to not swing as wide, but I still thought it was kind of swinging. I went ahead and put a straight strangle on at once.
And then, since slightly putting on the spot, because you didn't know a whole lot about the leveraged ETF, and again, like I said, this is more of what I'll do looking into the comparison. I'm wondering if you had any thoughts on the U Pro. So the fact that it's 3x leverage, yes, it has this much wider swing like we saw in the pandemic crash. I mean, it went from $40 to $10. In the world where I am holding spot shares in this strategy, like I just laid out, do you see? And I guess the question is, do you see that as, because of the leverage, potentially being better reward, because it is still technically tracing the S&P, so it is still quote unquote up only, even though there are more dramatic pull downs. So is that more, let's say, I hesitate to use the word capital efficient, but more reward with still muted risk because of the recovery of the chart, or it's just a completely different calculus there?
So, this is something that I think is awesome about premium selling and option selling is I don't really care what the product is. I don't really care what it represents. I don't really care anything about that. I think the numbers tell whether or not it's worth it. And I don't. We'd have to pull up the option chain to see what the premium is, see what the volume is. Is it liquid? Because if we go to my main criteria is it liquid? That's first and foremost. Is there enough liquidity there? Are the bid and ask spreads nice and tight? Second question is the volatility elevated relative to itself? So it doesn't really matter how much this underlying moves up or down, right? It's how volatile is it right now relative to itself. And if it's historically higher than it normally is, then premium selling is the way to go. And the way that I would kind of equate that to where I trade, right? I go to earnings, and I don't really care if it's Campbell's Soup earnings, where the expected move might be 1%, maybe 2%, or Datadog or Snowflake, right, where the expected move might be 15 to 20%. That doesn't matter because the premium that's reflected in there is a function of the volatility and the underlying price. And so you might not earn as much dollar amount from it, but from a percentage basis, from a how much buying power does it take, right? All that is going to be relative to the risk and relative to the volatility. So honestly, I don't think it will matter what that underlying actually is. Yeah. So Viper, in summary, what you're kind of laying out, like you alluded to, was kind of going to be a dude. Were you ever present in some of these episodes? I'll grant you, it is a slight tweak on things, but really what you're looking for is the wheel strategy on an index in an IRA is largely what I hear from you, and that's a perfectly legit thing where you're selling premium, and if you hit it, you hit it. If you don't, like this is on the put side, right? If you don't, then you keep it and you do it again. And you collect premium while you wait for the price to come down to that level that you're good for assignment at. And I would say in your particular case, when you're doing it in a retirement and you kind of want to go long because you want to get the other side of the wheel going, selling the call on it, you can be more aggressive with your strike. And instead of starting at a 10 or 15 delta, you could come up to a 25, a 30, a 35. Heck, if you really wanted to start the wheel, just start right off at the 50. Do it right at the money. Sell a put right at the money. Particularly on an underlying like an index, which is generally up and to the right. You might have a pretty good probability of not hitting that and keeping that. You still got to check the liquidity and how far out the spreads go. Like I said, with a lot of ETFs and things, sometimes those are a little bit not so wide. But it's a perfectly fine strategy. And if you get assigned, like you said, you're just own shares of SPY. And a lot of people's retirement account own shares of SPY. And I think if you couple that with your price levels that you're looking at, and you start to sell calls as you approach them, but still do it out of the money, you might get a reaction off that level and you might get a rejection. Now, if you flip that level and it becomes support and you soldier on through, that's where you're going to have to be okay with kind of leaving a little bit on the table, right? You're not going to sell that call at a loss, so you're going to be profitable. It's just you might rise past that and you're going to leave on the table whatever you get assigned at. You can still roll that, rolling in the money and kind of keep it going if you want. But if you're doing the wheel, you might as well get out and you'll probably get more premium from the put side. And it's going to be a profit anyway. And you can't lose sight of that, right? Nobody gets in trouble for taking a profit. I think too many times a lot of traders and people get in their heads that they can only cash in for a green or for the mega, not just green, but for the mega green, for the peak. You can only, buy at the absolute bottom. You're never going to buy at the most absolute bottom. You're never going to sell at the most absolute top. So be happy and be content with the profit that you can pull in and then do it again.
The last thing I'll call out to that point, because I think it's important, especially anybody that hears this and wants to start digging into learning more about it. This for everything you just said, as far as missed opportunity, which is a very important, like you said, distinction from it's still profit's profit. The big idea here, which I want to drive home, is the time frame, the time horizon of this account is obviously much further down the road. So that opportunity, yes, there will be moments where opportunity cost is a thing and it, it hits the covered call. I miss this gap of, not having the shares on hand. But because we're on a long time horizon, the odds are potentially in my favor that at some point in this 15-year, whatever it is, time horizon, that we do go sideways. And when we go sideways, now I am recuperating that opportunity cost because, I'm wheeling on important price levels and we're going sideways. And so I'm grabbing premium, and now I'm recuperating that and potentially outperforming the spot hold. It's nothing's guaranteed, but that time horizon I think is important to highlight that if I needed this money in a year or two, yeah, absolutely forget this spot hold and all that kind of stuff. But on a wide, long time horizon, the potential for recuperating through that premium, I think, is pretty high to come out pretty good in the end.
Yeah, the other thing that people a lot of times use this for is steady income, and I think that's what you'll experience from this strategy more so than anything else. Is you'll see steady appreciation at a pretty consistent rate, where one of the holdings that I have, right? I have a particular holding, and I go to sell covered calls against it, and I generally sell about $400 worth of covered calls every month on it, and so I have these shares and it turns into roughly $400 a month. And that was really big into when I started trying to go to the strategy, is because my goal for my trading account was to be able to practice a steady income flow for when I enter retirement, that I'm not drawing down on something, but I have built something up in a manner that is repeatable month after month after month to a pretty consistent income rate flow. And I think that is one of the things you give up for that, is those big gains and leaving something on the table. And that's where you have to be prepared mentally for that. So that brings us to the end of this week's episode. Viper, that's a very interesting strategy that you laid out. I would highly encourage you to try it out, to start it. I think you'll experience more of that option selling premium that I have built my entire strategy around. I think you will find it pretty amicable and a pretty good steady state of income flow for you. Just remember to always pay attention to the liquidity of whatever that vehicle is that you're looking at. And you're going to want to look for that historical elevated volatility. I speculate that over time, not right now for sure, but I speculate in times of bull market or really positive drift upward, you're going to find that premium really, really evaporates because that volatility is really just going to drop off. But right now, when volatility is where it is, I think you will find this a very nice extra bump in things. And I think that approach is very much like that ant that is going out and trying to develop his strategy so that he's got a little bit of extra food for the winter. And doing it in an IRA is a great learning area. It's particularly one that is not really your main IRA, and it's just kind of a, like you called it, your YOLO IRA. I think there's a lot of learning that can be had there without any of the implications of taxes or anything like that that could really mess with your particular income filings or your expect, like you hit it big, like, oh, guess what? You don't even have to claim that as a capital gains at all because it's all hidden in your IRA in that tax insulated account. If you have big losses, bummer, that stinks, but you're not ever going to affect anything outside of that IRA sandbox. So I think it's a great approach to have. I'd be very interested to see how it pans out. I would definitely pay attention to the tweaks that we talked about in here, but because I think those will naturally kind of come up, and ask questions in the Discord. If you're out there and you're kind of wandering around and thinking this is pretty interesting, hop in the Discord, ping your strategy off of some of the people in there. We love to kind of, and it's not critique, but we love to kind of hear other people's strategies, and you can get feedback from us. Some of the traders, we have some great people in there that are really kind of zeroed in on price action and constantly kind of posting things that keeps them sharp. But I also learn things from it. So yeah, I mean, hopefully out there in this volatile time, there's a lot going on. So whether you're trading shares, selling premium, or whatever it is, keep a level head out there. Focus on the mechanics. Focus on the fundamentals. Good luck. Have fun, and remember, think outside the block.